Hi, everyone. Welcome back to the podcast. I'm Bill Gebhardt, founder and executive director here at 10 Dynamics. Well, February was a month of reversals and big moves. Bonds successfully tested their lows and rallied. Equities tried for new highs and subsequently ended in free fall. And European energy made two-year highs only to finish the month at the lowest level of the year. So with this renewed volatility, what should we expect going into the end of Q1? Well, let's break it down. Let's start with the biggest headline at the moment, U.S. equities. As of our filming, the current decline in the S&P 500 is the largest sell-off since this bull market started in November of 2022. And our model sees this as a clear change in investor sentiment. VIX futures also entered an uptrend in the final days of February, confirming this change in psychology. Underlying those movements, the big tech market drivers like Nvidia, Tesla, and Google have simultaneously lost their uptrend ratings. Overall, our model indicates that this could be the beginning of a bigger downtrend coming in the next several months. Last month, we drew an analogy between the crypto and equity markets. And then when you see a big divergence in major equity indices with rampant speculation and high-risk stocks, you're often looking at a precursor to a decline. Well, this is exactly the situation in crypto at the start of Feb. Ether was in a strong downtrend as Bitcoin was bumping against its highs, and meme coins were going ballistic. This analogy held true as Bitcoin has since fallen nearly 20% and lost its bullish trend rating. While it hasn't quite turned bearish yet, any further declines from here and our model will likely suggest more significant downside to come. In other financial assets, a move of note is that U.S. government bonds made a successful test of their lows from over a year ago in late 2023 and have rallied over the last month, putting them in the middle of a large range with now no clear trend. In Europe, as mentioned, energy prices reached the highest level in 2 years early in the month, but then sold off dramatically, with gas prices currently down over 30%, as the market continues to try to make sense of the news of a possible deal in Ukraine and conflicting theories on its effect on gas supply to Europe. This quick reversal took our model from a strong uptrend to a moderate downtrend in natural gas, with power and carbon emission prices following gas lower. Lastly, while we model the domestic Chinese futures markets, we don't often mention them here because they aren't closely followed. But it's very interesting that we're seeing several commodity markets in China ending bearish trends and new bullish trends emerging. This could be a sign that industrial demand is picking up in China and that they could be experiencing an upward economic cycle in 2025. So with that in mind, our chart of the month in February is a pair of base metals, copper and aluminium. And yes, I said that correctly. As industrial metals, they're confirming what we're seeing from the Chinese commodity markets, where newly emerging uptrends are signaling a new upturn in global industrial production. Our model suggests that these two markets could emerge as uptrend leaders in the coming months, and we'll be watching them closely as a result. Okay, now let's turn to our current trend strength by sector. In the commodities area, the big change we discussed at the opening segment is the rapid move to a bearish average trend in EU energy. The big question now is if this will become a durable trend to lower energy prices for Europe, or if it's just a sign of more volatility as uncertainty around Ukraine's future persists. Now, if we look at the oil complex, it continues to be the least interesting area for investing. It's really had no trend since June of 2023. So how long can it stay in this tight range? Well, no idea, but we're watching it closely for signs of something, or anything, to change. In the financial section, we've seen some recent dollar weakness, but so far this hasn't manifested in the trend strength, and the model still sees downtrends against the US dollar. Our model also sees the crypto sector in a downtrend, as mentioned earlier, and US treasuries are overall trendless at the time of the film. Now finally, in the equity space, where all the action's been, you can see the VIX is in a strong uptrend, and all other areas are now showing no trend from what were strong uptrends. We'll watch this closely for the emergence of a downtrend in equities later this year. Okay, so for today's Under the Hood segment, let's talk about how we handle portfolio construction. Well, our philosophy of limiting any optimization includes portfolio optimization. And while in theory we should be able to improve performance by optimizing our portfolio weights, we feel that in practice it's hard to beat deliberately equal weighting within major risk categories like energy, metals, ags, etc. So we risk weight all assets within specific categories equally. And by risk, we mean the volatility of each asset. If one asset has a volatility of 10% and another has a volatility of 20%, our maximum position size in the first will be twice the maximum position size of the second. It also means that no single position can be bigger than the size of the portfolio divided by the number of assets. So for example, in a well-diversified portfolio of say 50 assets, no single position can be more than 2% of the total risk of the portfolio. This methodology reduces key 2 risks associated with portfolio optimization, ending up with too much weight on a single position and large changes in correlations resulting in very different portfolio returns than what was expected. We feel this approach balances model risk with market risk and is conservative while still allowing each portfolio position to meaningfully contribute to the overall performance. Okay, well, that's it. So for more information about systematic and trend following investing, head over to our LinkedIn, YouTube, and Spotify pages to make sure you're receiving all of our latest content and ideas. Earlier this week, our new fact sheets were delivered to those investors already on our monthly distribution list. And if you're a professional investor and you'd like to receive our data going forward, please contact us at inquiries@10dynamics.com. As always, thank you for listening and see you next time with more thoughts from the machine.